Hello and welcome to our viewers on Crux Investor. We're here today with Mike Young from Vimy. We're going to talk about a number of subjects today, so look in the description below to see what those are, click on the relevant timestamp and that'll take you to that part of the video. And if I can ask that you click the button in the corner of the screen to subscribe to our YouTube channel, and if you want to see more videos like this, click the notification bell. Mike, how are you?
I'm well.
You're here.
Happy to be here.
Yeah.
Destroy at 5 for 272 in the cricket.
Oh, just leave it.
Okay.
Leave it, seriously.
All right.
People are turning off right now. You're here at the WNA. That's what you're here for.
We are. So we're here for the World Nuclear Association Symposium,
Yeah.
and we've also spent a couple of days on the road
Right.
with Bacchus Capital. Which is
So let's start with that
Okay.
first. Okay. So you've been talking to a few institutions, family offices,
Yep.
about the potential of raising some money.
Well, it's called a non-deal roadshow. So
Sure.
basically what you're doing is just introducing Vimy to these people in the event at some point in the future you might raise money.
I've never seen a non-deal roadshow,
That's
which
right.
isn't
It's always
about
got
raising money.
Well,
but
no, I mean, you look at our balance sheet and you say, okay, well,
it's
at
obvious,
some
right?
point in the not too
At some
distant
point.
future.
Exactly. So
So it's a pretty typical formula. Yeah.
we've all been there.
Yeah. What's been good is that the caliber of people we're seeing is high, and that's because
And what's the mood?
The mood's actually good. I think we've come out of a couple of years where the mood's been bad. And what's interesting is that the mood of the investors is quite independent of the WNA, because most of these people won't be at the WNA, but the WNA itself, which I think Julian might talk about later.
Absolutely.
The fuel report is the best one that's come out in the last 7. So
Got it. But back to these investors.
So the investors are people who understand the macro, uranium macro. Some of them,
of
them already own uranium shares and have, in fact, some of the people we saw have small uranium funds. We picked Bacchus Capital on purpose because they did the yellow cake float, so they get uranium.
Okay. They don't. These people you're seeing, investors, they understood the macro situation and the supply demand. And the economics. What were most of the questions about? What were we fielding?
Well, when's the price going to go up? That was the constant theme was, when are you going to write a contract? I think there was an expectation. So let me back up a bit. They understand the uranium macro, but unless you live in the industry, you don't understand the micro.
Sure.
And there's a lot of different micros that are pushing in different directions.
Like what? What do you mean?
Well, for example, contracting. Okay, so people. I think people expected the 232 decision to have some sort of effect on the spot price, like it would have in, say, gold, copper, or nickel, where there's a market and a speculative market, and it just didn't, because the spot price is basically a reflection of the contracting that's going on, and there was just no contracting. Nobody wrote contracts the day after the 232. Now, part of the reason was it was August and it was North America. I mean, the place closes down.
So let's not get drawn into that well-trodden path of 232 working group committee. But what did you have to explain that to them, or were they aware of what had been going on?
No, we really a lot of the discussion revolved around exactly how the utilities operate, why they're taking their time, the timing, and what our expectations were. And as we explained to them, the early contracts aren't going to be much more than the current price, the term price, and that's because you've got lower cost producers.
Okay.
So as we move into there's definitely demand, and we know that open requirement has to be filled. So,
well, you say there's definitely demand, but there's still timing on that, right? There's not demand today.
No, they're burning material they bought 3 years ago.
Right. Okay.
Yeah.
So demand is coming, is what we're saying. The demand story is understood.
Correct.
Right. So but did these investors understand that?
No, a lot don't. A lot of the investors are they're commodity investors, and I made the same assumptions when I started in this space, that there's more immediacy in most other commodities than there is in
and understanding
uranium. Pardon me?
And much more understanding of other commodities than uranium, right?
Correct. And uranium is more like LNG, liquefied natural gas, which are long-term contracts that are. It's very similar. In fact, I was having a discussion in Perth with someone in government, and they actually. I remember one of the policy advisors said, "Hey, that sounds just like LNG," and I went, "Well, it kind of is like LNG, right? There's a very small spot market, and there's this time lag." So I think there's a couple of things at play. So people have uranium fatigue. Yep, heard it all before. It's going to come. It's going to come. And this is what I mean about the micro. So some of the things like yellow cake, for example. we've never seen that before, where a group comes in and buys that much uranium and sequesters it. It's basically parked, right? Because they trade on net asset value. You've got Kazatomprom, which is now westernized. So 2 years ago, they were behaving
partially westernized. Surely.
Well, but they still have an accountability to their guidance they never had before.
Okay.
Okay.
Let's say that's true.
Well, Riaz Rizvi, who's their chief commercial officer and does the marketing, says that's true, right? He says that we have to be careful now because we have a responsibility. But not only that, they have westernized their accounting. I mean, when Riaz went in there, they had old Soviet-style accounts and they were just churning out the pounds. That's how they measured it. They weren't looking at margins. So that's different. I think the utilities, their buying habits may change. They used to write these 10-year contracts. I think that may change. The contract cycles may come down lower. So there's a lot of different things that are, some are interconnected and some aren't, that are different this time. But the thing is, the 232 really focused, I guess, everyone's attention who were outside the industry on it, because it got a lot of airplay. But in terms of the contracting cycle, what will happen over the next 18 months as they fill their forward requirements is the early bird will get the worm, right? The early contracts will get the cheaper prices and they'll basically climb up the price curve.
Sure.
And because we sit in the third quartile happily, we'll be one of the people getting contracts as they creep up the curve and the price increases. Because as they continue to write contracts, the lower price material will start to disappear. And as Julian will talk about the long-term macro, there is a supply deficit. We can see it. And another thing, so we talk about investors not getting part of the uranium market. What's interesting is people in the uranium side don't get investment side.
No, absolutely.
That's really interesting.
Absolutely. Look, and I don't want to focus on that today, because we've talked about some of those things. Yeah, but I'm interviewing.
Yeah, that's right.
So all that's fascinating. I was just interested in the mindset
let me just
of
finish that
investors.
thread, because what's important, and again, this is about long term. What people on the buy side of uranium are missing is just how long it takes to put new production into the marketplace.
Absolutely.
And that's really fascinating, that both sides don't quite
They've got different objectives, so I understand, and we've covered that on a few meetings that we've had the past couple of days. So, but I want to talk about you. That's why you're here, okay?
I want to talk about me.
Okay, good. We're on the same page at last.
That's right.
So we're Vimy. You've got a couple of assets. Talk about Mulga Rock, etc. Where you're at with those very quickly for people, because I want to get into talk about them.
So Mulga Rock DFS finished. We're looking at a refresh, if you like, just looking at some of the things. We want to try and get our capital costs down,
right?
Particularly on the mining fleet side. So there's 100 million there of Australian mining fleet, and we think we've got a solution to that. So we're working with people on that.
Solution to do what?
Just to take,
shave things.
Yeah, so in the DFS, we made the assumption that we would manage and own the mining fleet. Now that has inherent risk. It's the cheapest option on paper, but if you have problems with your mining fleet or mining, then it becomes a more significant problem. Whereas you can put that risk onto an earth-moving contractor, but you pay a bit more, and that goes onto your operating side. So things like that, staffing levels, cost of people. 18 months ago, a mine manager was different price than he is today. Things like that. So we call it a refresh, if you like. So we're doing that. There's not much else to do on that. That's just going to be market driven. So you get the contracts, you get the debt. We have talked to debt providers on this trip.
Okay, this is what I want to talk about. I want to get into this, the numbers, okay? Because you've got a couple of good assets. You're at DFS stage. You know what you've got a sense of what you've got, you're refreshing that, get it, but you're in this kind of waiting period, this twilight zone, where like everyone, right?
No man's land,
right?
That's right, yep.
But you've now got a sense of the economics of this project. Have you got, or have you made decisions about how you're going to go to market? You've got lots of options. The DFS tells you a lot of stuff. It doesn't necessarily mean you've got to follow that path as laid out, because the market changes, prices change, as you said, and financing will drive this.
Correct.
The type of financing you get can drive this. So you're having some debt conversations. At some point you're going to have some equity partner, strategic partner type conversations
Having
too.
all those, yep.
And they're all happening now. Well, tell us about those.
Yep. So we have put feelers out there saying if you would like to partner with us, come in on as a JV partner. Minority.
Where have you gone out to?
Oh, everywhere you can imagine. So China mainly. That's the one place. Where
everywhere in China, then.
Everywhere, yeah, everywhere. Mainly China.
Right.
The U.S. utilities don't do that. Right,
Okay.
so that's off the table. They just don't take that risk. They tried it once. They took some shares, but they don't do that sort of partnership. So China is the main one for strategic partners, but we've basically started a process of just letting people know that if you're looking for a strategic partnership, that could be a large equity group, it could be a PE fund. I mean, they do that in gold. They'll go into.
So this isn't the case of like I'm going to hand the keys over. This is
a case of
strategic partnership.
Yeah,
together.
You can earn into say, for example, you earn into 40% of the project through a sale on a fair valuation, and then you have 40% of the offtake. Okay,
so where are these conversations then? I mean, I'm interested to understand. Are you getting the sorts of prices that you're thinking you're getting? Cost of money? You're not that far advanced?
Not that far down.
Okay.
In terms of pure debt, we have had. We did announce some time ago that we had SocGen doing some work for us, Société Générale. Natixis is now upping their presence in Australia. They've just done a merge with a boutique advisement firm. They're French banks. They get uranium. We talk to the Australian banks all the time. And then there's some non-traditional style debt here in the city that we've said, look, this is our model. We have a minimum contract price. We've made it public. It's $55. We need $55. That's our floor. We get more, right? The study was done at 60. The feedback from the utilities is that your price expectations for 2023, when we would likely be in production, are realistic.
Okay.
That's the feedback. Now, they're not signing contracts today for that,
sure,
but they do the maths as well. So what we do with that is we say, okay, here's our financial model, here's the numbers that we're inputting, this is the debt we need. And then we sort of flex how much will you have, how much offtake will you have? Will it be 50%, 75%? And the answer is, you tell me because you're lending me the money, right? So we need to know what the payback is. So those are and they're not things that are announceable. They're just anybody who understands the space would assume I'm having those conversations.
Right. So help me understand a little bit of it technically around what DFS has got in it. I imagine it tells you what it's going to take to get the uranium out of the ground, right?
In terms of cost.
In terms of cost, economics around that. Does it factor in transportation to, I don't know, port, to end user? He's nodding. He says yes. So
that's
the economics guy.
Yeah, that's right. So he that you're pointing at is
Julian Tapp. Yeah.
Yes, he's sitting way over there because his brain's so big we couldn't get him at the table. So yes, so we basically the ownership transfers at the converter. So we deliver it to the converter, and then they take possession and pay us.
And that's your $55?
Yes. Yeah.
So how do you do that? It surely depends where they are in the world and what the cost of is, right?
Sorry, where?
You can't say it's $55 if you're selling to China. It's going to be a different price if you're selling.
There's only three places it can go,
right?
And that's France,
right?
Blind River, Ontario, which it's delivered at Halifax and then railed, and then it's.
There's going to be some variation, but
there's a little bit, but it's absorbed.
Not meaningful, right?
No.
Okay, I understand that. So that's interesting to me. And who on the team? I know you're keeping a really tight ship. We talked about it before. Okay, you're not hiring people you don't need to hire now. You hire them when you need them. If the price hits 55, and you can get some contracts in place, and you can press the big green button, how quick are you into production?
2 years. So FID to production is 2 years.
Build and spitting out product at the other end.
So I think the first year is 2.9 million pounds in year one, and then we ramp up to 3.5 by the end of year two.
So that's kind of quick into production. There's no kind of
actually
ramp up
to me
stage?
To me it's not. Yeah, there is a ramp up, but it's actually because we pre-dig some of the pits and stockpile, because the pits will become the pits will become the tailings facilities.
Right.
So as part of the build, we actually dig some of the pits and we have stockpiles sitting on the surface. So that assists with your ramp up, right? So we got the ore ready to go. So 2 years to me seems really short, really long, because when I ran that iron ore company, we went from our very first drill hole to first ore and ship in 4 years. So a 2-year build is, and our well, he was our COO and he's still on our board. Tony Chamberlain shook his head at me and said, "This isn't an iron ore mine." You know, it's like, okay, whatever.
He's right. Well,
yeah, I know he is, but you know, we have to build a camp. But the plant's relatively small. I mean, it's a big mine. It's 8 kilometers long, 2.5 kilometers across at its widest. We'll mine it like a strip mine, you know, so there's a lot of dirt to move, but the plant itself is actually relatively small because the front end we do beneficiation, we wash sand out of the ore, reduce the volume by 50% with no loss in uranium, and so suddenly you're dealing with a relatively small amount of material.
So relatively, compared to a lot of people, 2 years is a short time, just to let you know. I haven't heard anyone today say less, for instance, in terms of the juniors who are not producers, okay? It's 3 years. So you're ahead of the curve there. That's actually something. That's something that people should take note of. But what does that tell you in terms of timing for the conversations that you do need to have? I know you're speaking to utilities, but you're going to have a different conversation with them today than you will maybe for a year's time. But are you getting? They're giving you indications about what makes sense to them. But at what point do you actually start talking about contracts?
Oh, we've been doing that for 2 years. So one of the things...
No, meaningfully. Like,
okay,
you know,
let me take you through the process that
right.
we did, right? So we had to actually... So let's go back to our strategy. So we had to think about where do we want to sell uranium. So you look around the world, you go, who are the 5 top countries using this stuff? Well, it's the US, it's France, it's China, it's North Korea, it's Russia. Okay, sorry, South Korea, it's not North Korea. They're off our list, just so you know. So you got your top 5, right? So of those 5, Korea only buys at spot, and they have some pretty arduous contract requirements, so they're gone. China and Russia, well, they're sourcing their material from the stands, so they're not real, unless you have a strategic partnership, we're not going to be selling a lot of material there, and China's probably going to buy on the spot anyway. So, and look, to be frank, the 2 countries you want to be looking at, of course, are France and the United States. Now EDF fuel buyers have told us we're only going to buy from people in production, so now that you got the US.
That's interesting, okay.
Now, what's interesting about that is they're about 28% of the market. So that's a big part of the market. So, okay, we're going to do the US. Is there in fact a market for our material? Well, the way the US utilities manage their portfolio's is they like to spread the risk, and they actually layer cake it, they base load it with, say, a Cameco, and then they'll actually have these little tranches, right, that are absolutely set for juniors from Australia. So what we did, we went around to all the utilities and we said, price being no object, what's your requirement?
Who's your guy in the States? Who's your guy in the States?
Scott.
Right, okay, so he's there full time. You have been thinking about this, you have been having these conversations, you're readying yourselves.
Correct.
Okay.
And one of the things we've addressed previously is our D&A and our overheads, right? And we had, what was interesting is that conversation came up, you know, what's your spend, what's your burn rate? And what we did recently was we had an EGM where we voted, we got permission to do salary sacrifice.
Right.
The reason for that is I wanted to buy shares in the company, but I don't want to reward someone for selling them, and this keeps money in the treasury. And some of our staff, some of our directors have gone up to like 50%. So that's one way of saving money.
50% of what? What do you mean?
Of their salary, they actually receive in shares.
Okay.
So we've done that as a way of saying to people, you can buy shares in the company, but the money stays in the company, which is it's a really good win-win, right? So it's a way of saving money. So one of the things we had to look at was, okay, how ready do we want to be? So to answer your question, when can you push the big green button? You can't downsize to a point where it's going to take you 2 years just to person up again, right? Before you press the button. You want to have your team ready. So that's why we've got Scott on board. That's why we've got Julian. Julian's working part-time. Scott's working part-time. So we've sort of struck a balance. We downsized the office a bit. We've done a lot of cost-cutting, cost savings. We've got the team ready to go, because this is the sort of market that'll flip very quickly. One day we've got a contract and they'll cascade.
So it may well flip quickly, but the point at which it flips is undetermined at the moment.
Correct.
And I've heard very different views as to when
From
it's going to
people
go.
inside the industry.
With people inside the industry, and that's one thing. You'd think they would have a bit more of an insight. That's why I'm interested. That's why I'm at the WNA. I want to see what the mood is, what sense you're getting from utility groups. And I think Julian's going to talk to us about the fuel report in a moment. But what's your take on when this thing starts to motor? Because some junior companies won't be able to make it through to the end because either they need to go and raise some money. I know you were raising some money. That's one scenario. But people who need to go and raise some money can't raise some money because people are getting a better understanding of the fundamentals of uranium and perhaps that company, and they had their moment in the sun when they could raise money and may not be able to now. So that's
a really interesting question, right?
Seeing those sorts of things.
That's a really good question. And one of the things the fuel report does talk about is it does talk about who is ready, right? Think about a Formula One race. Who's in grid? Who's in pole? And when you look at that, there's not very many.
I agree.
And that's our point of difference.
Yeah.
That we have kept the guys on board, ready to go.
We've
got an ore reserve. We're going through those secondary approvals, the building permits, if you like. Those will be done well before we have all the contracts we need for the debt. My window is 18 months. My window is the next 18 months. We get contracts and we move into FID towards the end of next year. That's my working
I think
hypothesis.
That is wise. That's wise indeed. Because we've been asking people of the 55 old companies which are around. Do you think many will be around if this thing does go on another 12 months, let alone 18? What do you think?
Well, I think some people will fall by the wayside, partly because they were in it for speculation, not for to build a long-term mine.
Right.
And we're about building a mine and building long-term value, because when I ran BC Iron, that was a $13 million listing. And by the time I left, it was a $650 million company, and it got up to 800 before the iron price fell. Yeah. They were selling in a spot market. But, we generated a lot of value. Right. And that was by getting into production, paying dividends. You just bring on a different class of shareholder. And, the people on our books, so we've got some major shareholders in Andrew Forrest and Satcham Cove, Mike Elkin, Paradise. They're all long, right? They're not in this to make a quick buck.
So your message to shareholders is what? To existing shareholders, what are you going to say?
Thank you for supporting us and continuing to support us. And we've always said this is a long story, and the people that are in, they get that. We'd like to get some share appreciation along the way. That's what Alligator River does for us. So that's a shorter term exploration play with a longer term development play. So that was part of the reason we brought that in, because I know through my experience that if you're building a project, there's 2 years of not a lot of news. You're just putting this thing up and sending pictures of tanks being welded. Isn't that sexy? So Alligator River gives us that extra.
You hope, right? You hope. Yeah. There's no knowing in this market, right? No. But you point it. So existing shareholders, they're in it for the long haul. It's going to be fine. Yeah. You may get a bump with Alligator River, or not, depending on how the market reacts to what's going on. And it's a question of waiting for this price discovery. Yes. That's the only way you can affect share price, because the reality is it's out of your control.
It's existential. Absolutely.
Okay.
Thanks, mate.
Good to see you. We'd love talking to you every single time we speak to you, and you're over here.
All right. Well, hopefully there will be more, because I hope we get some of these London groups to come in, and that'll give me an excuse.
Let us know how that goes. Let us know how that goes.
Because we have to get a beer.
We do need a beer. I'm very good at beer, so let's do that.
Oh, you played rugby.
Exactly.
So there you go.
Thanks very much for watching. We hope you enjoyed that. And if you did, please click the button in the corner of the screen to subscribe to our YouTube channel. You can also catch us on our website, cruxinvestor.com, and Cruxcast, our podcast series. Plus, most days you can catch us on LinkedIn and Twitter. We'd love getting your feedback, so please keep that coming, and we'll speak to you again soon.